Well, the United States and Europe are going full steam ahead into the data center gold rush. That rush has just entered its next phase of growth, with most future projects now coming from outside of the big tech sphere. Joining us live to track that and other key trends shaping the real estate landscape is Elizabeth Bell. She is co-head of real estate at the private markets firm Hamilton Lane. First thing, Elizabeth, great to see you.
Thanks for having me. Great to see you.
Let's talk about data centers. One of the first lines in your notes in bold that there is no data center bubble right now. That might stand a little bit outside of the recent consensus that we've heard.
Yeah, I think we approach it from the real estate perspective. So we're investing in real estate buildings and data center buildings. From that side, you want to say, okay, what's going on with supply and demand? And when you look at it, the demand side is going gangbusters. Since 2010, demand for data centers has increased 200%. And most of that was being driven by the cloud computing and digital transformation. And a little bit of AI is starting in now. What we see looking forward as this AI trend continues, and think about it, we're on the cusp of AI adoption. You know, that will take off. You need so much more computing, and the supply is just not keeping up with this demand.
Well, take us into the due diligence process, because we talked to a lot of folks here on The Close and elsewhere on the network that there is this concern that, you know, there could be overbuilding underway. That I hear what you're saying when it comes to the demand right now, far outstripping supply. But you think about technology, it tends to get smaller over time, so it's hard to estimate, you know, the physical footprint needs. And, you know, I wonder how you approach that question.
Yeah, I think we try to strip away some of the technology, bigger themes, and really look at the real estate fundamentals. And getting back to that, when you see the supply, it's under 2% for vacancy is under 2% for most of the market. And you look at a market like Virginia, it's below 0.5%. So we feel good about that. When you look at the forward growth, we're looking at partnering with groups that are doing build-to-suits. So you're not taking on speculative risk. And they're mostly working with the hyperscalers and big credit names where you're securing long-term leases, 15, 20 years. They've got escalators in place, and they have, you know, great underlying credit quality of the tenants. So we really do believe in this space long term.
So that's obviously been a big theme for 2025. I'm sure it'll be a big theme for the next couple of years minimum, at least. I want to talk a little bit more about multifamily housing, particularly given that we sit here in New York City. We have a mayor who's going to be inaugurated in a few days, who ran on a big platform of housing affordability, trying to create more housing. From an investment standpoint, particularly from Hamilton Lane's investment standpoint, do you see opportunities in that, particularly here in New York City?
Yes, we remain very bullish on New York City multifamily. Again, getting back to the supply and demand fundamentals, there's not enough housing. There's a housing shortfall in New York. We're seeing very strong demand come back. You know, don't bet against New York. The city is thriving again. And where we see actually Mondami come in is creating a great buying opportunity today. So we saw prices reset, you know, valuations went down after the rise.
And when you say buying opportunity, buying existing multifamily properties?
Yeah, it is still very difficult to develop new. But on the existing, you kind of have the benefit today of a price reset after the interest rate hikes. So you're at a better basis. And then I think there's a lot of fear in the market with Mondami, especially if you have a mixed building with some, you know, rent stabilized and free market. So we just make sure that we're buying right and underwriting potential zero growth.
But I am curious about that mix, though, because, I mean, for those who don't understand the New York, I mean, basically you can have a building where you have market rate rents and at the same time have what they call rent stabilized rents that effectively are capped as far as how much they can go up. His whole platform, though, is, I guess, trying to maintain that cap and in some cases lowering that cap to a certain extent. So how do you make that profitable? I mean, how do you know if you're going into a project that it's going to be profitable?
So when we're looking to buy existing assets, you look to see the mix. We're not targeting anything that is, you know, has too much rent stabilized, because there is risk there, and it will cap rent growth. You know, he can influence the rental rates through the rent guidelines boards. And, you know, he's going to start to nominate people to that board. So we will have to assume in our underwriting 0% rent growth for anything that's rent stabilized. But if you go in at an attractive entry basis and you still have a great proportion of free market rents, you can grow those and still achieve a great return. And the debt is becoming much more competitive for multifamily today. So you're getting a really nice spread on your yield spread over debt.
So high conviction when it comes to New York City. Let's talk about the other end of the country. Let's talk specifically about San Francisco. We know it's been a turbulent couple of years for the city, also a turbulent couple of years for the city's real estate. What are you seeing there now as we head into 2026?
So seeing is believing. I went to San Francisco earlier this year and seeing what the new Mayor Laurie did, where he's cleaning up the market, he's being much more centralist in his views and policies. He's welcoming the AI companies back. It was very vibrant. I was there a few months ago, the cleanest I'd ever seen San Francisco. So that helps in this kind of change towards, do people want to live there? I think we're also seeing general, obviously AI growth. I think we are a little skeptical or cautious as to what that means for the city there, because that is where valuations of public companies influence what people are being paid, what they can pay for rent. But I think it's still a strong market today, so cyclical. You want to get in, get out. But then you also look at, what's going on with back to office. People are there. People are going back into office. We joke the people at the AI companies are going in 6 days a week now, 7 days a week. So we think it's a great entry point, again, given that the city was hit hard. But we like that, and I think we'll be much more cyclical and quicker to sell once we achieve our return targets.
I am curious, though, too. When we talk to a lot of real estate investors, a lot of them shy away from places like New York and San Francisco, not because they're uninvestable, but because they find better opportunities in the Gulf Coast and the Sun Belt type of states there. Are you actively involved down there? And what's the relative attractiveness of those areas to a major city like New York or San Francisco?
Yeah, Roman, that's a great question. Yeah. And I think a lot of real estate investors, especially during the pandemic, flocked to the South, to the Sun Belt markets that had high growth potential, lower cost of living. However, unlimited land, right? Or unlimited land. What we love about a New York or a San Francisco is the high barriers to entry. It is very difficult to build in those cities. You look at Manhattan, it's on an island. You've got San Francisco with topography there that makes it difficult to build. And those are strong markets that, even if there's not a lot of growth, there's a significant population and housing shortage to begin with. So today, then get to your point about the pricing. It was a little bit cheaper to build in the Sun Belt, or better price attractiveness to do that. But today, because of the reset in values, you can get in at New York City at a great value, and we believe in the city long term. We'd prefer to invest there today.
All right, Elizabeth, this is a great insights, great roundup here, and we got to catch up with you in 2026 to see how things are shaking out. Elizabeth Bell is the co-head of real estate over at Hamilton Lane.